So if you're invested in retail, Q3 in Spokane was definitely a gut check. The market's experiencing a pretty severe split right now.
Yeah, it really is.
Vacancy, well, it officially climbed past the national benchmark. That's fueled by major corporate downsizings.
Mm.
And yet you've got this almost desperate demand for stable new assets driving record pricing per square foot. It's wild.
Welcome to the deep dive. Yeah, today we're focusing entirely on the Q3 2025 Spokane Retail Market Report. We're going to try and dissect the commercial dynamics at play.
Right.
Everything from, the leasing velocity, the pretty abrupt stop in construction activity right through to capital markets and those macroeconomic factors shaping Eastern Washington.
And we're really cutting through, it's hundreds of pages of raw data analysis charts, trying to give you the most important strategic takeaways fast.
Exactly.
And just to be clear, all the figures and insights we're about to share, they are derived exclusively from that market report you shared with us.
That's right. Our mission here is pretty simple. Analyze this data stream, turn it into actionable strategic knowledge, and do it quickly. We know your time's valuable.
Okay, so if you've been watching the market, here's the snapshot. It probably confirms everything you've been feeling about Q3. Let's hit the headlines.
All right, if we boil the full quarter down into just a minute, here are, say, the 4 major bullet points kind of driving strategy in Spokane retail right now. First, demand and vacancy. They're definitely struggling. Vacancy rose to 5.4%.
Which is huge compared to national.
Oh, yeah, dramatically higher than the national 4.3% benchmark. And Q3 net absorption, it was negative, over 30,000 square feet. That marks continued stress on existing inventory.
Wow. Okay.
Second, rent and pricing. Stable on average, but honestly, that average is pretty deceptive.
Right, hides a lot.
It does. Overall, asking rent growth slowed a bit, 1.5% year over year. That's about $1,673 per square foot NNN. Roughly matches the national rate, which is 1.8%. But like you said, massive divergence in the submarkets underneath that. Yeah, we'll get into that. Third, supply and construction. Sharply constrained. The pipeline of space actually under construction, it shrank drastically. Just 42,000 square feet.
41.6, yeah. Compare that to what, end of last year?
Exactly. End of 2024, it was 216,000 square feet. So big drop.
Huge drop, okay.
And finally, capital markets. Still highly suppressed. Sales volume is, well, it's on track for the lowest volume we've seen since 2020.
Okay, so if you remember just one thing from that quick summary, it's this. The market is polarizing, really polarizing. Large format legacy space is struggling severely, almost creating a crisis in some spots. But that specialized, high quality, stable retail, it's intensely competitive.
Yeah, the capital's there, but only for those, bulletproof deals.
Exactly.
And just really quickly, before we dive into the data that confirms that polarization, if you need any further context or maybe custom breakdowns, or want to dive deeper into specific trades we mentioned, make a note of this contact. Eric Peterson at 509-903-9077.
Okay, let's start with, well, the root cause of this market anxiety, that vacancy surge. Overall market vacancy hit 5.4%. And availability is even higher, 6.7%. The market absorbed, as you said, negative 30,149 square feet just in Q3. That contributes to negative total absorption over the last 12 months. This is a really dramatic slide from that market low of 3.3% we had at the end of 2023.
And it didn't happen by accident, right? It's the result of several large-scale retail departures hitting the books kind of all at once.
Like what?
Well, the prime example is Burlington. They executed this massive downsize at Franklin Park. They went from a huge 157,000 square foot store
Huge.
down to just 23,000 square feet. Same center.
Wow, they didn't just downsize, they nuked 85% of their footprint there. That's a staggering amount of square footage to suddenly go vacant in one complex.
It is. And then you have to layer on the pain from just general chain bankruptcies. The report specifically calls out closures related to Big Lots and Joann Fabrics.
Right, more big boxes hitting the market.
Exactly, adding more large boxes to the inventory. And this pressure, it's highly concentrated. You see it notably in neighborhood centers that are now at a 9.1% vacancy rate. And the mall sector, sitting at 6.7% availability.
So impact here, it's really focused directly on owners of those older, larger retail centers. They're now left with these significant blocks of vacant space, these big boxes that are just incredibly difficult, time-consuming, and expensive to backfill, especially if you're looking for a single replacement tenant.
Yeah, absolutely. And looking ahead, the critical thing to watch in Q4 is just the sheer volume of space still coming online. The market has to somehow absorb the 200,000 square feet of total space still scheduled for delivery in 2025.
200,000. Still to come.
Still scheduled for this year, yeah. That volume is going to seriously test the current elevated vacancy rate, especially, if it's not all pre-leased.
Okay. So, if existing space is struggling to fill, what does that say about the appetite for new space? Let's move from the availability crisis to the supply side. Trend number 2. The construction pipeline freeze. The numbers are, well, they're a major shock when you look at the drop.
Yeah, they really show a sharp contraction of developer confidence, I think. Construction activity is massively constrained. The current square footage under construction is, like we said, a mere 41,569 square feet.
Just tiny compared to before.
It is. Compare that to 216,000 square feet at the end of 2024. That's a deep, sudden pullback.
But okay, if inventory is this tight in some of the high-demand, high-performing areas, shouldn't developers be willing to absorb those rising costs we've seen? Is this just caution, or is financing just not there?
It's likely both. I mean, it's certainly a combination of rising construction costs and, a hyper-cautious lending environment, especially given the higher availability rate we just talked about.
Yep.
Developers are probably waiting for much better clarity on long-term demand before they commit to new speculative product. And lending standards are definitely tight.
Okay, so while the immediate development risk is low because so little is actually being built this supply vacuum, it does promise maybe a stabilization benefit down the road.
Potentially, yeah.
It suggests that once this current wave of inventory delivers and eventually gets absorbed, maybe the vacancy rates find a floor, maybe tighten up again.
That's the hope. And a critical detail from the report on the pipeline front. Those 5 properties currently underway, the ones totaling the 42,000 square feet, they're actually 36.3% pre-leased overall.
Oh, okay. So there is some activity.
Right. It confirms the market is willing to finance highly specific smaller projects, often anchored by secured leases, but definitely not speculative large format space right now.
Gotcha. And the largest single project?
Bridgeline Center Building 1. That's 15,000 square feet.
Okay. That need for specificity, it perfectly sets up our third trend, hyper-local rent growth. That overall market growth figure, 1.5% year over year, it's almost meaningless because the submarkets are just showing such extreme divergence.
Yeah, this is really where segmentation hits hardest.
Yeah.
It reveals who the winners and losers are. The highest growth by far. South Hill submarket. It saw an amazing 12.0% QTD annualized rent growth.
12%, wow.
Yeah, and they also command the highest rents overall in the metro, $23.28 per square foot NNN. The Spokane CBD also did pretty well, 2.9% QTD annualized growth.
So 1.5% market average sounds, okay-ish, but when you see a 23-point swing between the top and bottom submarkets,
Right.
that 1.5% average becomes kind of strategically irrelevant for anyone making actual investment decisions.
Absolutely. And on the flip side, you saw serious pain in the SE North metro area. That saw the largest QTD decline, clocked in at negative 11%.
Ouch, negative 11.
Yeah. This divergence just shows how specific market forces, whether it's high-income density or maybe a lack of recent retailer confidence, are affecting individual neighborhoods.
Yeah.
Meanwhile, general retail reigns the stalwart category. It still has the lowest vacancy rate at 4.0%, strong rental rates around $15.94 per square foot.
So the actionable takeaway here for you, the listener, is that investment viability is now tied directly to submarket performance, not just the metro average. Quality assets in those high-demand, high-income areas like South Hill, they're clearly capturing disproportionate growth. They're acting like a safe haven for capital right now.
Exactly.
Okay, let's turn now to the transactions roundup. Q3 sales, heavily dominated by private investors, you mentioned that, and with a year-to-date volume of just $85.5 million.
Yeah, 85.5.
The market's on track for the slowest year since 2020, and most closed deals were small, under $1 million.
Right. And to understand the market's behavior, we really need to focus on a few key deals closed in, July, August, September 2025.
Right.
They illustrate this current polarization in the strategies people are using. First, look at the quintessential example of aggressive pricing for core brand new retail, that Raising Cane's deal, North Newport Highway, closed mid-September.
Okay.
It's only 2,862 square feet, sold for $3.7 million.
Wait, $3.7 million for under 3,000 feet. That's over $1,200 a foot.
It translates to a massive $1,293 per square foot.
Yeah. For context, I mean, that price per square foot, that's usually reserved for prime Manhattan or maybe high-growth core market assets, not necessarily a drive-through in Eastern Washington. That's the definition of paying a premium for security and zero risk.
Precisely.
Yeah?
That deal represents the absolute upper limit for new, single-tenant, high-quality retail assets in this market right now. Then you have the yield hunters, right? The ones willing to stretch on cap rates for stable income. Look at the 3501 East Francis Avenue sale, also in September. 5,554 square feet, sold for $2.7 million at a 5.2% cap rate.
5 cap, wow.
That is incredibly aggressive pricing in the current interest rate environment. It just reflects how, maybe desperate isn't the right word, but how eager private buyers are to secure small, stable cash-flowing assets that don't require much management.
Yeah, makes sense. And because of the rising vacancy we talked about earlier, we are starting to see the emergence of the value-add strategy too, right? Indicating some buyers are willing to take on pretty massive risk for future upside.
Yeah, the 2210 North Madison Road sale back in July. Perfect case study. 8,560 square feet, sold for $3.5 million. Crucially, the property was 44.2% vacant at the time of sale.
44% vacant, okay.
So that buyer is explicitly pursuing a value add or maybe a repositioning strategy. They're betting they can backfill that huge vacancy, probably at a higher rental rate down the line, but that requires expertise and, a certain risk tolerance.
Definitely. And geographically, the sales activity kind of confirms where the attention's focused.
Yeah, Spokane Valley saw the most geographic activity in the first 3 quarters of 2025, topped $30 million over the trailing 12 months, driven mainly by those smaller private player transactions we've been talking about.
Okay. So this brings us neatly to the capital markets snapshot, which really defined these trades. As you pointed out, private investors account for, well, the vast majority of sales, almost exclusively targeting those smaller assets, usually $1 million or less. Institutional money, largely paused. What does that dominance of private capital tell us about cap rates and overall stability, though?
Well, overall, the 12-month average cap rate for Spokane Retail is 6.4%. However, the year-to-date 2025 completed transactions actually saw a slightly tighter average, 6.2%.
Interesting. So tighter for deals that actually close.
Exactly. It suggests that while overall volume is severely constrained, the specific assets that do manage to trade successfully are still being priced aggressively by those private investors. So it's maintaining valuation stability, but really only for high-quality, stabilized product.
But the report clearly flags these persistent economic headwinds, right? The things constraining overall investment volume and keeping the big capital on the sidelines.
Oh, absolutely. The report explicitly cites 3 main risks constraining the market. First, slowing population growth. Second, lower than average wages compared to the national benchmark.
Still an issue.
Still an issue. And third, a documented slowdown in retail sales right at the cash register. That indicates real pressure on consumer spending.
Okay. So looking ahead then, Q4 2025 into 2026. What does the report forecast? What are the forward watch items that you should really be tracking?
Well, we have maybe 2 major economic pressures and 1 key inventory pressure to monitor closely. First, that ongoing inventory pressure.
The 200,000 feet.
Yeah, that 200,000 square feet of retail space, still slated for delivery in 2025. That's going to be the ultimate test of the market's current ability to absorb excess inventory. It will likely keep vacancy rates elevated, at least in the near term.
Makes sense.
Second, the core economic dilemma. Affordability versus wages. Spokane's median household income still lags the national average. You combine that with rising housing costs, apartment rents are up, 20% since 2020?
Yeah, significant jump.
It's going to continue to exert pressure on consumer discretionary spending and, overall retail sales performance.
Right.
But despite these pressures, the overall forecast suggests, maybe, projected stability. Market asking rent growth is projected to stabilize at about 1.0% for 2025 overall, gradually improving, they think, to maybe 1.8% by 2029. But that assumes we see moderate, sustained economic growth.
Which is a big if these days. Okay, so here's a final thought then. Given the massive amount of large format space, those big vacant boxes freed up by chain closures and downsizings like Burlington, the real Q4 question, maybe the question for next year, is whether distressed or adaptive reuse investors will actually step in. Will they aggressively utilize those huge available blocks of space?
Good question.
Will we see retail centers convert to medical offices or maybe entertainment or even non-traditional retail concepts? That feels like the potential game changer we should be watching.
Yeah, what happens to those boxes is key.
Well, that concludes our deep dive into the Q3 2025 Spokane retail market. Thank you for sharing your source material with us. We really hope this analysis provides some clarity for your next strategic move.
And remember, for further detail or maybe a custom market breakdown tailored to your specific assets, don't hesitate to contact Eric Peterson directly. That number again is 509-903-9077.
Until the next quarter's data hits our desk, keep that information flowing. We look forward to diving deep again soon.